It was a call that came in quite late. After 10 p.m., Warren did not like calls at that hour. Unless something truly important was happening, I still remember him looking at the phone, letting out a quiet breath, and only then picking it up. On the other end of the line was a middle-aged man, his voice tense, saying he was considering mortgaging his house to buy Bitcoin. His nephew had just made a few $1,000,000 from cryptocurrency. Lamborghinis. Numbers flashing on screens. Promises of $1 million per coin. All of it sounded very convincing. Warren listened to everything. He did not interrupt. When the call ended, he remained silent for a long time. Then he said, just one sentence to me. Every financial bubble begins with a story that sounds reasonable at exactly the right moment. And when I hear what is happening with Bitcoin today, I realize the story has returned. Almost exactly the same. Over the years of closely following Warren Buffett, I came to realize that he never spoke about the market by starting with dry numbers. He usually began with a very ordinary, very small story, but one that reflected precisely the state of an entire financial cycle. Once, Buffett said that during the period when Bitcoin was being discussed everywhere, when prices were approaching levels that left people overwhelmed, he received a rather unusual phone call. It was not from an analyst, nor from a large investment fund, but from an ordinary person, standing in front of a very big decision in his life. That person asked whether he should mortgage his house to buy a large amount of Bitcoin. The reason sounded so familiar that Buffett only needed to hear a few sentences to know exactly where the story was heading. The man's nephew had made millions of dollars trading cryptocurrencies. Now he was driving expensive sports cars, living a life that left anyone who looked at it feeling overwhelmed. And the man did not want to be the one standing on the sidelines while the greatest opportunity of a generation was unfolding. He did not ask about risk. He did not ask about worst-case scenarios. The only question he cared about was whether Bitcoin could rise to $1 million per coin, just as many people were predicting. When telling that story, Buffett did not appear surprised. He simply smiled and noted that he had heard very similar questions before. Only the name of the asset was different. There was a time when people believed a single flower bulb could be exchanged for an entire house. There was a time when companies that had never earned a single dollar in profit were valued like empires. Prices, according to Buffett, can travel very far when speculation reaches its peak. But what he always cared about was never how high prices could go. What he paid attention to was another question, mentioned far less often, but far more important when the excitement fades. Who will still be holding onto their money? Buffett once told me that over many decades of observing markets, he arrived at a rule that almost never changes. When everyone in the room believes they are smarter than the market, that is usually the moment the market is preparing to send the bill. In private conversations, Buffett once told me that he always found it interesting when people assumed he did not understand new assets. In reality, the opposite was true. He understood them very well, sometimes even better than the people putting money into them. The same was true with Bitcoin. If I had to stand on the supportive side, I could present an argument that sounds more convincing than many of the people buying it today. The reason is very simple. Most Bitcoin investors I have met cannot explain why they own it, beyond two familiar points. The price has gone up, and many other people are buying it. But that does not mean this side lacks intelligent people. On the contrary, there are names large enough to make anyone stop and listen. Buffett once noted that when extremely serious people begin to participate, the story automatically gains more weight. A technology CEO put tens of billions of dollars of his company cash into Bitcoin, not as an experiment, but as a survival strategy. The world's largest asset management firm, with trillions of dollars under management, also opened the door to investment products linked to Bitcoin. These are not people making emotional bets. They have teams, models, and data behind every decision. Their central argument revolves around a very attractive concept: absolute scarcity. Bitcoin was designed with a fixed limit. It cannot be expanded. There is no committee that can vote to increase supply. There is no government that can print more when needed. As most of the supply has already been created, Believers argue that each remaining coin will become more valuable over time. Optimists often compare this to gold, but they go further. Gold, though scarce, can still be mined more if the price is high enough. A new discovery, a new technology, and supply can increase. Bitcoin is not like that. Its rules do not depend on market price. That rigidity, according to them, is its greatest advantage. Buffett listened to these arguments very carefully. He understood why some people were willing to bet entire companies, even their reputations, on a future where Bitcoin either becomes worthless or reaches numbers that still sound absurd today. When major banks begin issuing six-figure forecasts, and when famous investors speak of even higher prices in the coming decade, the story is no longer a side game. And that is precisely when, in Buffett's view, the important question begins to appear. Not whether the argument sounds good enough, but what it is leaving out. Because for Buffett, the greatest risk rarely lies in what people talk about the most. It lies in what no one wants to talk about. One morning, while sitting for coffee with Buffett, after a long meeting, I asked him a question that many people had recently been asking me as well. What captures your attention the most when you look at Bitcoin right now? He did not answer immediately. He flipped through a few pages of notes, then said that the most important thing to observe was not the price, but who was entering the game. A few years ago, Bitcoin was mostly in the hands of individual speculators, fast traders, high risk, largely driven by price volatility. But that picture has changed. Names that Buffett never ignores began to appear. BlackRock, the world's largest asset manager with around $10 trillion under management, has launched Bitcoin ETFs. These ETFs alone now hold more than 6% of the total circulating Bitcoin supply. Fidelity has allowed Bitcoin to appear in long-term retirement portfolios. And then there is even a country, El Salvador, which has officially recognized Bitcoin as legal tender. This is no longer a fringe phenomenon. Optimists are quick to connect this with a familiar historical memory. They bring up the dot-com bubble. Yes, most internet companies in the early 2000s collapsed, but the internet did not disappear. Instead, it became the foundation for Amazon, Google, Apple, companies that created trillions of dollars in value for shareholders over the decades that followed. Their argument is that cryptocurrency and blockchain are at a similar stage, and that Bitcoin could be the final survivor. Buffett understands this comparison well because he witnessed it from the inside. But what caught his attention more was how the story kept expanding. People were no longer talking about Bitcoin as just an asset. They were talking about an entire new ecosystem, DeFi, decentralized finance, a world where borrowing, lending, and trading happen without banks. Smart contracts on Ethereum, executing automatically, no lawyers, no intermediaries, peer-to-peer lending, cross-border, 24/7. Then the story extends into monetary policy. In conversations, Buffett often points to the COVID-19 period as a psychological turning point. Governments printed trillions of dollars. The M2 money supply in the United States surged in a short period of time. When money can be created almost without limit, people naturally look for something that cannot be diluted. Bitcoin, with its hard cap of 21 million coins defined by mathematics, became central to this argument. Supporters continue to strengthen the story with network effects. Bitcoin has the largest security computing power in the crypto world, the highest liquidity, the strongest brand recognition. When people think of crypto, the first name that comes to mind for most is still Bitcoin. In technology, the leader often captures most of the market, like Microsoft with operating systems, Google with search. Then specific numbers appear, not from anonymous accounts. Standard chartered projects, Bitcoin could reach $200,000. Kathy Wood at ARK Invest talks about prices in the millions within 5 to 10 years. Robert Kiyosaki openly mentions the $500,000 level. Tom Lee at Fundstrat has issued similar forecasts. These are people with large followings and real capital at stake. Add to that the halving mechanism. Every 4 years, mining rewards are cut in half. New supply continues to decline. History shows that prices often rise sharply in the 12 to 18 months following each halving. The most recent occurred in 2024. And for many, that suggests the current cycle has only just begun. Buffett once admitted to me that at this stage, the optimistic side is not telling an empty story. There is real technology, real institutional money, real adoption, and mathematically, the combination of fixed supply and rising demand is a very difficult argument to dismiss. But it is precisely at the point when everything sounds most reasonable in the way Buffett looks at markets that the most important question begins to appear. Does a story that makes sense also mean a good investment, especially at the current price? There is a reflex I have noticed that Warren Buffett almost always has whenever he hears someone say they are investing in Bitcoin. He usually pauses very calmly and then points out that what they are doing is not investing. It is speculation, not to appear superior, but because in his way of thinking, the line between those two concepts is the line between building long-term wealth and gambling with the money you have. The way Warren looks at markets, the biggest problem has never been Bitcoin or cryptocurrency itself. The problem is that more and more people can no longer tell the difference between investing and speculating. And when an entire generation confuses the two, the consequences rarely arrive immediately. But when they do arrive, the price is often the entire sum of money they spent a lifetime accumulating. Once Warren suggested a very simple question to me. Simple, but powerful enough to strip most financial decisions down to their core. If you buy Bitcoin today and you are forced to hold it for 20 years, no selling, no trading, no cashing out, no doing anything at all except holding it, would you still be willing to buy it? He said that your very first reaction to that question is the most honest answer you will ever get. If the thought makes you uneasy or uncomfortable, then it is very likely you are not buying for long-term value, but because you hope to sell it to someone else at a higher price. And by Warren's definition, that is not investing. When talking about investing, Warren Buffett always starts with a very basic principle that I have heard him repeat for many years. Buying a stock is in essence buying a piece of a real business. Not a ticker symbol on a screen, but an organization with tangible assets, with a brand, with intellectual capital, and with people who go to work every day to create products or services that society is willing to pay for. If that business is run properly, it generates revenue, then profits. And those profits are either reinvested to expand the business or distributed back to shareholders over time. That cycle is what causes value to grow naturally, slowly, but sustainably. Warren rarely uses abstract concepts to explain this. He prefers very ordinary, everyday examples. A good farm produces crops every year. The money it earns does not disappear. It is used to buy more land, improve irrigation, invest in more efficient equipment. That farm becomes more valuable, not because the market revalues it, but because it actually produces more output. Intrinsic value is built from the inside, season by season. His longtime partner, Charlie Munger, once expressed this idea very bluntly. Would you rather own something that continuously creates value or simply hold something you hope to sell to someone else at a higher price? That principle explains why Warren began investing at a very young age. His first stock purchase did not come from a desire to exit quickly, but from the fact that the business generated cash flow and paid dividends. He cared about how those dollars would compound over time, not about how the price might fluctuate in the short term. With the same mindset, Berkshire Hathaway bought shares of Coca-Cola in the late 1980 seconds, not because of a temporary trend, but because it was a global brand, a product consumed billions of times every year with stable cash flows across multiple economic cycles. To this day, that investment still generates hundreds of millions of dollars in dividends each year. In the way Warren sees it, that is a truly productive asset, a machine that creates value, not a ticket held simply in the hope that the next person will pay more for it. From the perspective of someone who has followed Warren Buffett closely for long enough, this is usually the point where his reasoning becomes very clear and even a bit cold. When the conversation turns to Bitcoin, the first question he asks is never, where will the price go? It is always times, what does it actually produce? Asterisks. And the answer, as he sees it, is nothing. Bitcoin does not produce goods. It does not provide services. It does not create jobs. It does not generate cash flow. It simply exists. When you buy it at $1,000,000, the only thing you are hoping for is that someone else will be willing to pay more for the exact same thing in the future. And during the time you are waiting, Bitcoin itself does not create a single extra dollar of value. I remember very clearly how Warren once explained this in a public discussion years ago. He said that even if he were offered ownership of all the Bitcoin in the world for a fixed price, he would not know what to do with it. Many people misunderstood that comment, assuming he was predicting Bitcoin would go to zero. That was never the point. What he meant was far simpler. An asset whose value can only be realized by selling it to someone else is fundamentally different from an asset that produces value on its own. To clarify that difference, Warren often returns to very concrete examples. If he were offered a small portion of America's farmland for a large sum of money, he would write the check immediately. Not because farmland makes for a good story, but because every year it produces corn, soybeans, wheat, things people actually need. The land does not sit idle. It works. Or consider an apartment building. Tenants pay rent every month, creating steady cash flow. That cash flow covers maintenance, services, debt, and still leaves profit behind. That ability to generate income is what makes it an investment. With gold, Warren has been consistent for decades. He acknowledges that gold has some industrial uses and aesthetic value, but most of its worth still rests on the belief that someone else will want to buy it later. He once pointed out that all the gold ever mined in human history could be gathered into a cube that would fit inside a baseball field worth roughly $18 trillion. With that same amount of money, you could buy all the farmland in the United States, plus several massive energy companies, and still have money left over. 100 years later, the land would still be producing crops, the businesses would still be generating profits, and the gold cube would still be sitting there unchanged, producing nothing. In Warren's eyes, Bitcoin is simply a more modern version of that same story, gold wrapped in a new marketing campaign. At least gold has thousands of years of history as a store of value. Bitcoin is just code, numbers in a computer system. Its value exists because people agree that it has value. That is psychological value, not intrinsic value. When people counter by saying that paper money is also just paper, Warren points to the core difference. The U.S. dollar is accepted for paying taxes, salaries, and legal obligations. Demand for it is enforced by an entire economic and legal system standing behind it. Bitcoin has no such guarantee. No one is required to accept it. And when the value of something depends entirely on whether the next person is willing to pay a higher price, then by Warren's definition, that is speculation, not investing. Now, when people talk about Bitcoin, they often raise a familiar question. What about the technology? From Buffett's perspective, he does not deny that blockchain is a notable invention. A distributed ledger can be used to improve supply chains, store medical records, or verify asset ownership. But the key point lies here. You do not need to own Bitcoin to benefit from blockchain, just as no one needed to buy speculative domain names to make money from the internet. Most of the domain speculators back then left the game with nothing. The real value was created by businesses that use the internet to serve customers better. Amazon, Google, Netflix. Buffett would look at blockchain in the same way. The eventual winners will be the companies that apply this technology to reduce costs, increase efficiency, and expand their competitive advantages, not the people who simply hold a token and wait for the price to rise. Owning Bitcoin does not give you a claim on those cash flows. It leaves you fully dependent on price volatility and crowd psychology. And when assuming that Bitcoin reaches a massive valuation, Buffett returns to his familiar question, where is the intrinsic value? A system that processes only a few transactions per second can hardly justify a market capitalization equal to or larger than the world's biggest economy. Being first is never guaranteed victory, especially in technology. MySpace, BlackBerry. What concerns him most is not the technology, but the behavior of buyers. People who enter out of fear of missing out because they see others getting rich, because the story is told loudly enough. Throughout his career, Buffett has seen this script repeat many times. From gold in 1980 to the dot-com bubble, the problem is not whether the story is compelling. It is, how much people are willing to pay for it. You can be right about the future, but if you pay the wrong price, the outcome is still losing money. When looking back at financial history, Buffett often returns to a very old example that still holds its value: the tulip mania in 17th century Holland. The specific details may still be debated among historians, but the essence of the story is not ambiguous. The price of an asset rose not because it created new economic value, but because buyers believed someone else would be willing to pay more tomorrow. At the peak, a single tulip bulb was traded for houses, land, and even the life savings of an individual. The participants did not think they were speculating. They believed they were holding something special. Tulips were beautiful, rare, difficult to reproduce quickly. Owning them conveyed a sense of higher social status. Buffett would pause here and recognize a familiar pattern. Those arguments sound not very different from how people talk about Bitcoin today. Beautiful in a digital sense, mathematically complex, a signal of technological sophistication and limited in supply. But history does not care how compelling a story sounds. When the tulip bubble burst, prices collapsed completely. What remained were flowers that still bloomed each season, beautiful but no longer regarded as an investment. From Buffett's perspective, this is not a rare accident, but a repeating template. Every major bubble begins with a portion of truth, enough to make the story sound reasonable. The internet truly changed the world. Prime real estate is genuinely limited. Blockchain is indeed a noteworthy technology. Then prices rise quickly. Early success stories emerge. And fear of being left behind pulls latecomers into the game at much higher prices. Then people begin explaining why this time the old rules no longer apply. When traditional measures are set aside, Buffett understands that the market has moved away from investing and into speculation. And the final point, which never changes: bubbles always burst. Not because people become worse, but because prices cannot remain detached from real value forever. The only real question is not whether it will burst, but when, and who will still be standing when it does. At the present moment, if viewed through the eyes of someone who has observed markets for many decades, Buffett would see Bitcoin converging on all 5 familiar signs of a bubble. There is a portion of truth that is convincing enough. Blockchain is indeed a noteworthy technology. There are early participants who made very fast profits, and stories of Bitcoin millionaires spread faster than any prospectus. There are explanations that sound highly sophisticated, from digital gold to an inflation hedge to the participation of major financial institutions. At the same time, traditional metrics are pushed aside as if cash flow, profits, or intrinsic value have suddenly become outdated. For Buffett, when basic questions are treated as no longer important, the line between investing and speculation has disappeared. At this point, the question is no longer whether Bitcoin is a bubble, but whether that bubble has already burst or is still inflating. Bitcoin has repeatedly revealed its nature. In 2017, prices surged in a short period and then collapsed by more than 80%, forcing buyers near the top to wait many years just to return to break even. In 2021, that scenario repeated almost identically. This is not healthy volatility of an investment asset. It is the characteristic of a betting game. Optimists today argue that this time is different because institutions are involved. But Buffett has seen that argument too many times in his life. Institutions do not eliminate risk. They only package risk in more complex language. The financial crisis of 2008 is the clearest proof of that. What truly concerns Buffett is not that Bitcoin exists, but the price people are willing to pay for it. Bitcoin at $100 is a small gamble with asymmetric upside and downside. Bitcoin at $100,000 is a large gamble with almost no margin for error. At that price, speculators need a perfect outcome to earn large profits while still accepting the possibility of losing most of their capital, which has happened many times before. The risk-to-reward ratio at this point is no longer attractive. It becomes unfavorable. Buffett often returns to the core lesson from Benjamin Graham, the mentor who shaped his thinking. The 3 most important words in investing are not technology, trend, or story. They are margin of safety. You buy below intrinsic value to leave room for error. And at $100,000, Bitcoin leaves no margin of safety at all. That price is built entirely on the expectation that someone else will be willing to pay more tomorrow. And Buffett knows very well that this is not investing. This is a question Buffett knows very well, a question that keeps many people awake at night. What if I am wrong? What if Bitcoin really rises to $1 million and people say you missed a once-in-a-lifetime opportunity just because you listened to an old man from Omaha who could not keep up with the times? Buffett does not dismiss that feeling. He has seen it repeat throughout his career. The fear of being left behind is an ancient instinct shaped by evolution to keep humans from being separated from the herd. But experience has taught him one very clear lesson. Every time he acted because of that fear, he regretted it. And every time he ignored it and stayed disciplined, he later felt grateful to himself. Suppose you buy Bitcoin today at $100,000 and 5 years later it reaches $1 million. You would multiply your wealth by 10. That sounds very attractive. But Buffett always asks the next question, what is the cost? Not just the risk, but the opportunity cost. With the same amount of money, you could own a collection of high-quality businesses that could deliver 8 to 10% per year for many decades with a much higher probability of success. In 5 years, that return might only double your wealth, but in exchange, you gain peace of mind and sustainability. Those businesses work for you every day. They generate cash flow, they pay dividends, they reinvest, they expand operations, they create real economic value. Your wealth is tied to production, not to the emotions of the next buyer. And Buffett always adds one more question. What happens if the optimistic scenario does not come true? He has seen too many people bet money they could not afford to lose on things that seemed impossible to fail. The consequences are not just numbers on a balance sheet. They are postponed dreams, vanished retirements, lost educational opportunities for children, not because people were foolish, but because they gambled on something they did not truly understand. Buffett often simplifies the issue with a comparison. If you have $100,000, you can choose to buy one Bitcoin. Over the next 10 years, it either becomes $1 million or goes to zero. During that entire time, it produces not a single dollar of income. It simply sits there waiting for you to find someone willing to pay more. Or you can choose to own a portfolio of businesses that have proven their strength over time. During those 10 years, you receive steady dividends, earnings grow, new products are launched, new markets are entered. A few companies may stumble, but the portfolio as a whole moves forward. In the end, the probability is high that you are wealthier because you own income-producing assets. Buffett does not need a complex answer to choose between those two paths. He asks only this: which path helps you sleep better? Which path does not require you to understand cryptography, complex technology, or predict crowd psychology? The Bitcoin story requires everything to go perfectly: technology, regulation, and the constant enthusiasm of new buyers. The story of productive assets requires only one simple assumption: that people will continue to consume basic goods as they have for hundreds of years. After more than 7 decades of investing, Buffett has reached a conclusion he repeats in many ways. Boring things tend to work. Flashy things usually do not. Buying good businesses at reasonable prices and holding them long-term never goes out of style. Chasing the latest trend rarely ends well. Buffett may look foolish if Bitcoin reaches $1 million, but that would not be the first time he was called that. He was mocked for not buying technology stocks in 1999, for not chasing gold, for not rushing into real estate before 2008. And in each of those cases, he slept well while the bubble inflated and then burst. The goal of investing, according to Buffett, has never been to maximize returns at any cost. The goal is to grow wealth steadily without taking risks that can destroy you. Bitcoin may make some people rich very quickly, but it will also make many others poorer. And Buffett knows one thing for certain: no one has gone bankrupt by staying away from what they do not understand, and no one has lost sleep for not participating in a bubble. The biggest difference between him and Bitcoin millionaires is not the size of their wealth. It is the quality of their sleep each night. His wealth does not depend on the enthusiasm of the next buyer. It is built on businesses that serve real needs of society across generations. It may sound dull, but that dullness becomes extremely valuable when you reach the age of 70, 80, or 90. And as Buffett often says to those overly excited by short-term luck, luck and skill look exactly the same in a rising market. Only when the tide goes out do you discover who has been swimming without clothes. And Buffett is patient enough to wait for that moment.